In the trading contest, there are 4 mandatory strategies that you will need to do in order to meet the requirements for this contest. Remember, having the highest return will not be enough to win the contest. You will also need to execute all 4 mandatory strategies. Let's begin. The first mandatory strategy is a bear call spread. A bear call spread is a moderately bearish strategy. It contains 2 calls with the same expiration but different strikes. The strike price of the short call is lower than the strike price of the long call. This strategy will always generate a credit, which is also known as a credit spread. To build a bear call spread, you need to go long a call option and short another call option but with a lower strike price. Both options need to have the same expiration. When using a bear call spread, the trader's outlook is to short the call to generate income, while the long call limits the upside risk if ever the stock rallies before expiration. The ratio of this strategy is 1:1. If you short 1 call, then you will have to buy 1 call. The maximum reward is limited to the net premium received. The maximum risk is the difference between the 2 strikes minus the net premium received. The break-even point is the strike price of the short call plus the net premium received. Let's take a look at the payoff diagram. Notice that A is the strike price of the short call and B is the strike price of the long call. The strike price of B is greater than the strike price of A. The break-even point is the blue dot between A and B. If the stock price at expiry is greater than the break-even point, then the trade is not profitable, but the loss is limited. However, if the stock price at expiry is below the break-even point, then the trade will be profitable as the stock price has dropped, but this profit is limited. If the stock price at expiry is less than the strike price of the short call, then both options are out of the money and the trader's profit will be 100% of the premium received. When a trader puts up a bear call spread, his maximum loss is when the stock price goes beyond the price of B. Ideally, the trader wants the stock price to be below A at expiry. The profit zone will be between A and the break-even point. For a predetermined return, the bear call spread has also a predetermined risk. As a trader, you will try to find a trade where the risk is the lowest and the return is the greatest. Let's take a look at a bear call spread example on Enbridge. The ticker symbol is ENB. First, you sell the $34 call and receive a premium of $2.69. The other leg of the spread is to buy the $36 call and pay $1.28. The spread will generate a net credit of $1.41. Now let's look at the risk analysis. The cost is negative because it's not a cost but it is a credit. That is why it's negative. The maximum reward is $141, which is the net premium received from the bear call spread strategy. The maximum risk is $59, which is the spread between $36 and $34 minus the net credit of $141. The probability of profit is 34.43% with a break-even point of 35.41. And these options have 54 days to expiry. To calculate the profit and loss of this strategy is straightforward. All you need to do is price each option separately and then calculate the net profit and loss at the end. In the first column, we have the simulated stock prices at expiry. If the stock price is below $34, then all the call options are out of the money. It doesn't matter if the call is long or short. The trader's profit is the net credit of $141 that he had received. Now let's look at the $35 price point. The trader will lose $1 on the short $34 call, and the long $36 call will be out of the money. The $1 loss can be offset with the $141 net credit. Therefore, the overall loss will be 41 cents instead of $1. The break-even point is $35.41. At this price point, the short $34 call will lose $141, which is exactly the same amount of the net credit received. If the stock price is above $36, which is the strike price of the long call, the trader will lose money, since both call options are in the money. The trader will be assigned on the $34 calls and will be obligated to deliver the shares at the $34 strike price. The trader will exercise the $36 calls to buy the underlying. The loss by buying the shares at $36 and then delivering them at $34 will generate a $2 loss. The loss will be reduced to 59 cents by the net credit of $1.41 received from the beginning. Thank you. If you have any questions, please contact us at contestadmin@tmx.com.